Hi, and welcome to Your Finance TV. We're here with Jeffrey Huge, founder at Alpha Insights. So it's a bit of a chilly snow day here on the East Coast, but certainly less snow than the big wigs have in Davos. So, we'll see how it all pans out. Jeff published his weekly playbook on Sunday, which is available on Substack at hugeinsights.substack.com. Jeff, welcome back.
Great to be here, Mehdi, as usual.
So, there's been a lot of things going on, and seeing a bit more volatility slowly creep into the system. But why don't we dive in, as always, with the top down?
Yeah, the only thing that really changed from last week to this week is the performance of the S&P 500. We had a big down 1.5% first week, and then we recovered everything we lost last week and actually rallied to a new recovery high, if you can believe it, but still have not been able to get over the finish line or into the end zone, if you will, however you want to look at it. The S&P has failed to make a new all-time high. Um, you know, and this has a lot of people stumped, because we've seen the Dow make a new high, we've seen the S&P 100 Industrials Index make a new high, and then we've seen the Nasdaq 100 make a new high, all at the margin. A lot of people feel like the S&P is next. It's probably going to do it, and I don't disagree. It probably will, but we'll see. It hasn't yet, and we have to play the cards as they're dealt, right? So the way we're kind of looking at it is day by day. We've been of the opinion that the S&P has been in a counter trend advance. One of the reasons we believe that to be the case is when we look at the broader market as measured by, say, the value line composite, which is the top 1,700 stocks in the U.S. Equally weighted. We're nowhere near making a new high. And so, the broad market really has a completely different tone to it than, the S&P 500. And the thing that is really the common thread between all of these indexes that have made new highs is that they're very narrow mega cap indexes. The Dow is 30 stocks, and two of them happen to be the two biggest companies in the United States, Apple and Microsoft, or Microsoft and Apple, depending what day of the week it is. And when you've got 14-15% of the market cap in two names, and they're in all the big indexes, it's going to have an influence. But more to the point, the top seven names represent 30% of the S&P 500 and over 50% of the S&P 100. And so those magnificent seven, AI tech darlings are the stocks that are driving these big mega cap indexes. And of course, the same is true of the Nasdaq 100, where up until the rebalance in late December, the Mag 7 actually represented over 60% of the index. It's now down to 45, 46%, I think, as of Friday's close. But at the end of the day, it is the Mag 7 that are driving the market, and we saw that in a big way last week. And of course, there are it is a divergent market there as well. Not all of the Mag 7 are contributing equally. And so, I think from this point, we need to really kind of look at this market with a grain of salt. Take the whole thing with a grain of salt and think, without these seven stocks, where would this market be? And so we've looked at it a couple of different ways. We also did a deep dive into Bitcoin, a lot of information, which we'll get into on that, and what the connection is between Bitcoin and the equity markets. And then finally, I think, we have a surprise idea for everybody. If you want to stick around and watch the entire video, you'll get our top actionable trade idea this week. I say that with a lot of conviction. This is my top actionable trade idea for the week as of right now. So I look forward to sharing that with you as well.
Well, Jeff, thank you for that rundown, and I'm very excited to hear about the top actionable trade idea. It's already got me tingling a little bit here. So you mentioned Bitcoin, which is obviously the hot topic du jour. Last week was, I guess some would say, a historic week where spot ETFs were approved. I believe 11 of them, so lots of activity around that space. The conventional wisdom would indicate that Bitcoin would go up, but after the approvals, we saw the approvals and we saw them start selling off, quite significantly. But do you believe there's still more, even more significant downside from these levels?
I do, and in fact, we published a video, another video on one of your competing services, but we did that on the day of the launch of the Bitcoin spot ETF, and we basically had the exact same message, and that is that you know um, we got this approval, right? This people are on the edge of their seats waiting for this. This has been something that's been going on since I think a Grayscale actually launched their trust, and this is the entity that has some 28 billion or had some 28 billion in Bitcoin in it at its heights. But the problem with this view that creating a spot ETF for Bitcoin is going to be the panacea that brings institutions into the market and advisors and every other cohort of investor outside of the retail Bitcoin speculating community, I think is absolutely wrong. And the reason I think that is because if we take a look at the advance in Bitcoin since really it became tradable, on a reliable basis back in 2014, we could see that each time there's been an innovation on an exchange traded product, it's marked a major or very important peak in Bitcoin. Back in December of 2017, we had the CME launch the very first spot Bitcoin or future Bitcoin futures contract. And that actually marked an important peak that was followed by a 55% decline. Then we had the Coinbase IPO, and this is the big broker and custodian of Bitcoin, where many of these ETFs are going to be custodying the Bitcoin actually. And that was a widely heralded event that also marked a major top. Then we subsequently saw I believe, 84% decline. And then we got the next Bitcoin exchange traded product, which was a futures ETF launched by ProShares. That marked the all-time record high within days in October of 2021. And we saw about an 84% or a 78% decline there. Now, since that time, we've had a very nice rally, a recovery rally that's carried to now 49,054 on the Bitcoin. That was the high. That was the big 6,000 point spike on the announcement of the spot Bitcoin ETF approval by the SEC. This was multiple ETFs. Some 11 new Bitcoin ETFs are now trading on the NYSE and various markets. But the point is that spike was the final hurrah, and what we've seen is the Bitcoin speculators have been more historically involved in buying into the hype and selling into the news. And so, my suspicion is that we did get a top in Bitcoin, a durable top, and we should see a pretty aggressive sell-off. Now, one of the things that we've done is we've applied the Elliott principle to the Bitcoin spot price. And what we've seen so far is it's held true to traditional Elliott wave rules. We've got a 5-wave advance, we believe, at primary degree of trend. The 5th wave itself subdivided very clearly at intermediate degree of trend. And so we can count 5 waves there as well. We can also count 5 waves down. Now, I'm not 100% sure of which degree of trend. We've got it marked as intermediate degree of trend. And if that's correct, then the initial decline was probably primary wave A of an ABC corrective waveform, because 5 waves up are always followed by 3 waves down, a corrective waveform. And so what we've seen since that 5-wave decline is a 3-wave advance, which is counter trend. And that marked primary wave B of this corrective waveform, which we believe ended with the announcement by the SEC of a spot Bitcoin ETF approval. Now, the initial decline to us appears to be impulsive, and it appears, it's some, I think, 15% off the high. It's maybe down 12% as we speak right now from its high. But I believe that's the initial foray of the next leg down, wave C down, which, if we're correct, the way we're thinking about this, we should see wave C carry all the way down to the lower boundary of the larger degree trend channel that we've fit in place by just simply connecting the lows and the highs, and it's a perfect parallel trend channel to the penny. So I think there's a very high probability that we see something in the neighborhood of a 80+% decline in Bitcoin down to the lower boundary. If we get there, it'd be roughly 7,500 on the Bitcoin. And so, we've kind of gone out with that as kind of being our de facto target right now.
Very interesting. And you touched on it in your opening statements. There's been kind of a correlation between Bitcoin and NASDAQ specifically. Does this imply you see a similar significant downside in NASDAQ as well?
Well, what it implies to me is a level of speculation. We've long considered Bitcoin to kind of be the tulip bulb of the 21st century, if you will. And our analysis of Bitcoin suggests that there really is very little to Bitcoin with respect to utility. Right? You're not going to buy order a pizza online and pay for it with Bitcoin. I guess it's possible, but you're not going to do it. It's impractical, right? Bitcoin, as far as utility is concerned, it's used for a lot of nefarious and illegal, industries. Drug dealing, sex trafficking, tax avoidance. These are the areas that Bitcoin seems to be primarily useful for. And so we don't really see a legal use case for Bitcoin, other than speculating on the price change, right? And some would argue that that's a perfectly legitimate, use for Bitcoin, and maybe that's true, but we just don't see it as being something that's going to displace the U.S. dollar as the world's reserve currency. So that's our thinking. But we've noticed that at least since 2019, there's been a very high positive correlation between Bitcoin and the NASDAQ 100, and that happens to be about 76% as we speak. And one of the reasons is both of these asset classes, if you will, are driven by narratives, right? It's a lot of hopes and dreams. Bitcoin is going to replace the dollar as the world reserve currency is kind of the dream, right? For Bitcoin advocates. And when we think about the Nasdaq, it's these this cadre of growth stocks that really it espouses the virtues of artificial intelligence, and so growth stock investors are really pinning their hopes and dreams to this new paradigm driven by AI, and both of these asset classes seem to be moving in tandem with that speculation. We think that both are putting in a double top right now. And if we're correct about our analysis in Bitcoin, a decline in Bitcoin should coincide with the decline in the NASDAQ 100. And we think it's going to be a rather epic decline.
So while we stay on this speculative investment side of things, you look at speculative long positions, which have obviously gone higher. And dare I even say, like, the record-breaking levels we're seeing here?
Last week, the CFTC data showed an all-time record high in speculative net long positioning in NASDAQ 100 futures, all-time record high. That speaks volumes to what's going on in these two markets, really. It is really driven by people making bets, right? These are not investments; these are speculative bets. And from our vantage point, it's completely one-sided at this point. We're already seeing a reversal in open interest in NASDAQ 100 futures. And so, this typically leads that change. And we think, a compression in open interest in a futures contract is pretty consistent with marking a top in a trend and preceding a trend reversal. So we think this is all, part and parcel to what's going on. High speculation in asset classes that really have no validation and really utility, if you will, rolling over in a big way.
Jeff, let's move away a little bit from the speculative side of things into one of the indicators that have historically been quite apt. Insider selling. We haven't really looked at this in a while. How's insider selling looking in market?
Yeah, we've talked about speculators, right? In NASDAQ and Bitcoin. Well, one cohort of investor that is not particularly enthusiastic about what we have to look forward to in the immediate future would be corporate insiders. These are C-suite executives and directors who have material non-public information with respect to what's going on inside their own businesses. They are selling at what I believe is an all-time record level right now. The insider sales to buy ratio hit 145. Okay. Let's put that in perspective. Above 20 is considered bearish. Okay. Below 12 is considered bullish. So we have over 400 million shares sold last week by insiders versus about 3 million bought. I looked back as far as I could find in the data I had. I couldn't find a ratio higher than that. I could be wrong, but I think 145 to 1 is a record high. And if it's not, it's very, very close, right? So I think we got to be a little bit concerned here. If corporate insiders are that worried about fourth quarter results, and they just kicked off on Friday, so we're going to get another slew of results this week, and then next week is the big one. We've got all of the big Mag 7 names, or many of them, reporting next week, and I think we've got to be very, very concerned about earnings going into this second or fourth quarter reporting period. So certainly insiders are, and I think you ignore that warning at your own peril at this point.
Well, it could be, big credit card bills after lots of Christmas spending, and they want to start paying them off.
Well, there's an old saying, insiders sell for a lot of reasons, but they only buy for one, right? We're not seeing any buying.
That's a very fair point. So we have an interesting slide here, which I haven't seen for a while, or if before. It's adjusted for inflation, and we're looking at the broader markets here. So talk us through this, because it's very interesting here.
Yeah, I've been thinking a lot about these new highs in the Dow and the S&P 100 and the Nasdaq 100, and I'm just, I'm mystified by it, honestly, because it does appear to be driven by this over-concentration in these stocks. But another factor that might be driving it is inflation. Prices themselves have been inflated dramatically. And so, I looked at, the CPI and the PPI. The CPI makes it look way better, but I decided to go with the PPI because, most of these, companies in the Dow, it's a little more balanced value, industrial, that sort of thing, but all sectors are represented. But, let's use their input costs to deflate the price by, right? And so what we did is we took the index price itself, divided it by the PPI index, just a flat out PPI index deflator. And we're looking at the closing prices of those indexes since 2009. And what I see is, an inflation adjusted Dow that's broken its primary uptrend and has yet to make a new high. I see an inflation adjusted S&P 100 that has broken its primary uptrend and is yet to make a new high. And I see an inflation adjusted Nasdaq 100 that again has broken its primary uptrend off the 2009 lows and is yet to make a new all-time high. So adjusted for inflation, none of these indexes have made new highs. And so I think we have to keep in mind the real influence of this heavy concentration in the AI darlings, right? The Mag 7.
So Jeff, that rolls us nicely into the technical side of things, and you obviously have two options here. Why don't you let us choose our own adventures here?
Yeah. So, of course, the bearish preferred count represents the view that we've been espousing for some time. Some would say that view is wrong. It certainly has been wrong, since October 27th and perhaps since March 15th. But when we think about, the count itself, we're counting either wave A or wave 1 down in the S&P 500 off the January 2022 highs into the October 2022 lows. That's either wave 1 or wave A down. That means that the advance since that time is either wave 2 or wave B up. It's a counter trend advance. it's choppy, it's overlapping, it's extended laterally. It's actually taken more time to not recover to a new high than it took to reach its October 2022 low. That's unusual for a new bull market, right? And so I guess we're looking at this as being an incomplete process, right? We've retraced 99%. Now a second wave or B wave, second waves can retrace 100%, but no more. B waves, if they're an expanding flat, can actually retrace slightly higher than 100%. We would give it 1 to 2%, potentially. There are examples in the historical record of B waves, going upwards of 20% above the prior high. That's possible, but it's very, very rare. So we're not looking for very, very rare. We're looking for kind of a double top scenario here. Now we've got a bullish alt case, and we've adjusted our entire count going back to 2009 in order to arrive at this count. And this count suggests that the COVID crisis lows in 2020 were actually primary wave 4. And if that's the case, then we're looking at primary wave 5 completing cycle wave 5. And it basically is suggesting that we haven't ended super cycle wave 3 yet. This is a distant alternate case for us. I think it's improbable that that's the truth. But if it is, and anything's possible in markets, it's just less probable. If it is the truth, then I think what's likely to be the case is that primary wave 5 will be some Fibonacci ratio of primary wave 1. It's very, very typical for wave 5 to have some relationship in its distance to wave 1. And the nearest would be a Fibonacci 2.618 times primary wave 1, and that would get us to 4940 on the S&P. So I think that's the highest probability alt, is that we're tracing out the final fifth wave of cycle wave 5 of super cycle wave 3, and we'll probably top around 4940 if that's the case. But before we can really jump to that conclusion, we've got to make a new high in the S&P 500, and we haven't done that yet. And so, by that measure, I need to put the bearish preferred count as being our first choice. And so under that scenario, our opinion is that we have either topped or we're very, very close to topping in this primary wave 2 or primary wave B. And the next decline will be 5 waves down, and that'll either be primary wave 3 or primary wave C. And we'll have to see how it progresses in order to determine which of those two. But in either case, I expect a epic sort of decline to pan out. But here's the thing, Mehdi, in either of these two alternatives, neither one really is particularly bullish. One gives you maybe like another 150, 160 upside points to the S&P, and then a top, and then a collapse in super cycle wave 4 down. Or we're completing, wave 2 or B, and we've got the next, most dramatic, a wave of the series to the downside going ahead. In either case, we see a double top forming in the S&P, and the next move of any significant consequence directionally will be hard down.
I was about to say that, ultimately we still end up in the same place with, when we get there sooner or rather than later. So, we're looking at the S&P on that side of things. Looking at the broader market, we're still obviously indicating lower here as well.
Well, the broad market's really what informs my view on the bear case, right? On the left-hand side of this chart, you're looking at the value line composite. The value line composite is the 1,700 largest stocks in the United States of America. It includes the Mag 7, but it's equally weighted. So it includes, 90% of all the revenue generated by all publicly traded companies in the United States of America. It's a pretty good broad representation of the market. And, we've only retraced slightly more than 50% of the decline. And we've now rolled over pretty substantially. And so my suspicion is that we've topped out in what appears to be, a running flat. And so wave one or A down, and then wave two or B up was just completed. And the next decline will be either wave C or wave three. We're showing this as an A, B, C, but it could be, an impulse pattern in development. So we'll have to find out. But the next move is to the downside in both these charts. On the right-hand side, it's a Russell 2000. These are the most liquid small cap stocks in the U.S. And again, we see the exact same pattern forming there. It's a lateral consolidation. Neither one of these indexes anywhere near a new all-time high. And we have not inflation adjusted either one of these. These are the actual prices. And so, we suspect that the next material move is to the downside in these broader market indexes. And I think that this is just, very consistent with our view on the S&P 500 right now as well.
So, Jeff, as your subscribers know, you publish your top actionable trade ideas every week. Generally, you have 5 longs, 5 shorts. For our non-subscribers, would you mind giving us a little taster here? I believe you were hinting at ISRG.
Yeah, I wanted to talk a little bit about sector relative strength first. And let me just preface it by suggesting that one of the areas that we're starting to see some reversal in is healthcare. Healthcare is not particularly overvalued. In fact, it's trading at a discount to the market in terms of the large cap healthcare space. And we have seen healthcare rotate into the underperforming or lagging quadrant of the RRG model, but it's actually stopped and reversed. And it looks like it's reversing up into the improving quadrant and could do so this week. We're already seeing that in the smaller cap. And smaller cap is more prevalent in the biotech space, right? We're starting to see a lot of M&A action in biotech and med tech. And so, the big cap space is overwhelmed by the big pharma names. And the big pharma guys are the guys that are making the acquisitions. And so those stocks will be somewhat under pressure. But what's interesting is that we are starting to see the rotation back into improving, even on the large cap side. And so, it's my suspicion that, this could be the one sector within the S&P 500 that offers both value and growth. It's like a traditional GARP area right now. And we've got some really good setups forming. And so to your earlier question, what is my top actionable trade idea? Well, I find Intuitive Surgical, ISRG, to be of great interest right now. The stock is setting up in what appears to be a classic pattern-based formation of the cup and handle variety. And the initial breakout or potential breakout above 365 looks like it's ready to run to around 460 and potentially as high as 560 longer term. This is a large degree pattern, so there's a lot of upside potential long term in it. I would kind of say that if we failed down around say 340, maybe 330, kind of that 330, 340 range, then that would probably mean that this is on hold temporarily at least. So that's where I'd set my stop to protect capital. But I think a sustained breakout above 365 would project a measured move to 460 initially, and then 560, which really makes this look like one of the most attractive setups in healthcare that we're looking at right now.
That's fantastic. Very exciting. And thank you for sharing that, Jeff. And, thank you for sharing all your thoughts from Alpha Insights for the week, Jeff.
Always a pleasure.
And I want to thank our viewers and make sure you check out Jeff's content on Substack at hugeinsights.substack.com. Until next time, thank you for watching and good luck investing.